Hello, everybody. This is Bennett Tchaikovsky. Welcome. This is I got a comment from a viewer, which is, can you please make a video on the worksheet to correct income and balance sheet errors, Wiley Plus 18th edition, illustration 21-16. And so just to kind of show you what this was really kind of looking at, is if we come down over here, comprehensive example, numerous errors. So this is what we're going to be kind of going through and creating today. So let's go ahead and I'll give my disclaimers. So this is coming from the Intermediate Accounting 18th edition textbook. Authors are Don Kieso, Jerry Weygandt, and Terry Warfield. The question used in this presentation is copyright 2023 by John Wiley and Sons. Wiley, all rights are reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 through 2024 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of myself and not the authors of the textbook or Wiley. Also, I am an employee at the South Orange County Community College District in Irvine Valley College. These are my opinions and not those of any of my employers or any other affiliated organizations. So let's go ahead and take a look at this particular question. So right over here, the company prepares a worksheet to facilitate the analysis. The following problem demonstrates the use of this worksheet. The mechanics of its preparation should be obvious for you from the solution format. I don't know what that means. The income statements of Hudson for the years ended December 31st, 2024, 2025, and 2026 indicate the following net incomes. So we have over here 2024, 2025, and 2026. So over here, a net income was 17,400, 20,200, and 11,300. So this is where we're going through and starting. Okay. Now, an examination of the accounting records for these years indicates that the Hudson Company made several errors in arriving at net income, the amounts reported. The company consistently omitted the records wages earned by workers but not paid as of December 31st. The amounts omitted were 1,000, 1,400, and 1,600. So basically, if we're doing a wage accrual at year end, it's going to look something like this. Salaries and wages expense as a debit for 1,000, and I would be going through and crediting salaries and wages payable, right? If I'm forgetting how to go through and record transactions, I can always go back to this over here. So assets equals liabilities plus owner's equity, expenses, revenues, debit, credit. We record our expenses with debits, our revenues with credits. Our assets are increased by debits, decreased by credits. Our liability and equity accounts are increased by credits, decreased by debits. So in this instance over here, what we would be going through and doing is, as of 12/31/24, we would be going through and making this journal entry, right? So, and this would be something like to properly record wages. However, this is an accrual entry. If they're never going through and doing things with it, and they're just paying the salaries as they come about, we have to go through and reverse the entry during the following period. So on 1/1/25, we would need to debit salaries and wages payable, and then we would credit salaries and wages expense. So, and the reason is because when the wages are actually paid, say like on January 6th, this is going to include this accrual so that we make sure that it's put into the proper period. We would go through and need to reverse the entry, right? Because the payment that's being made in the following year is going to include these wages that should have been accrued for in the prior period. So when we go through over here, we'll call this 1/12/31/24 payroll. This is, I'm going to increase my expenses by 1,000. So this is going to take down my net income by 1,000. However, it's going to increase because I'm going to be crediting the expense. This is going to increase the amount the next year because it's going to go through and reverse itself. For number one, 12/31/25 payroll. For 2025, again, well, I need to go through and record this adjustment. So what I'm going to go ahead and do over here is I'm going to be showing 1,400 because I should have basically, it's going to lower my net income because I'm going to be going through and doing a debit to salaries and wages expense. But this is going to go through and reverse in the following period. Lastly, 12/31/26 payroll. This is going to show a decrease of 1,600. Now, what's interesting about this is this wants us to go through and to, if I look at this particular problem, it's asking us to go through and kind of do a chart like balance sheet correction, debit, credit, the account. Well, over here for 12/31/26, I'm going to be going ahead and I'm going to be crediting this for 1,600. Why is that? It's because I have over here my salaries and wages payable. Okay, so this is basically salaries and wages payable. Okay, so that's number one. Let's go ahead and take a look at number two. The company overstated merchandise inventory on 12/31/24 by 1,900 as a result of errors made in the footings and extensions on the inventory sheets. Well, I never like these kind of questions unless I go through and I actually put the pedal to the metal, and we're going to go through and we're going to actually go through and use fake numbers. So let's just assume here for a second that our inventory was 1,000. Our inventory purchases were, say, 21,000, giving us goods available for sale of 22,000. And then let's just go through and pretend our ending, and again, I'm just making up these numbers, and we'll say that our ending inventory was 10,000, right? So our beginning inventory plus our purchases is giving us goods available for sale. And this over here is our ending inventory, but we sent over 12,000 to cost of goods sold. So if in fact we look at this example over here, again, I'm just making up numbers to go through and to make the illustration. If in fact, though, it says the company overstated merchandise inventory by 1,900. So now we overstated inventory. So instead of being 10,000, right, which was the overstated amount, we're going to go ahead and assume here that this was basically it was overstated by 1,900. So the correct amount should be 8,100. What's going to be the impact on cost of goods sold? Or my cost of goods sold is now going to be 13,900, or an increase of my expenses. So coming over here on 12/31/24, the inventory issue. So what it's going to do is that my cost of goods sold is going to go up by 1,900. So this is going to go through and decrease my net income by 1,900. However, this is going to be an error that will go through and self-correct. So the following period, you'll go through and see a $1,900 increase in income for the next year. Okay, because the beginning inventory is going to actually be lower than originally reported. So now let's go ahead and take a look at number three. I expense for basically, so over here, Hudson expense prepaid insurance of 1,200 on December 31st, 2025, applicable to 2026. So what I should have done is I should have basically had a debit to prepaid insurance. So for 12/31/25, it should have been prepaid insurance. And this was going to be for 1,200, right? That's what should have happened. However, I said insurance expense. So my expenses are too high. So I need to go through and add this back to 2025. However, in doing so, because I'm adding it back because I expense it in 2025 when I should not have, it's going to decrease my net income because it was applicable to 2026. So this is going to be something that's going to go through and reverse itself. Okay. So right over here, the company did not record interest receivable. Okay, so for number 4, when I go through and record interest receivable, what am I going through and doing? I'm debiting interest receivable, right? Which is basically interest on something where I am owed it, but I have not yet received it, but I've earned the interest. So coming over here, interest receivable in the amount of 240. And what I would have been crediting is going to be interest revenue for 240. So coming over here, if I didn't record it, this is going to increase my net income by 240. However, if I'm not recognizing it, or if the loan that I made is not going to mature until 2026, this will go ahead and go through and flip itself around. And let's just kind of go through for a moment and go through and check through our work. So as we see over here, the inventory overstatement, we talked about that, the wages being paid, and the impact over here to salaries and wages payable as a credit. And then over here, the interest receivable going through the accounts. Notice this is not having an impact on the balance sheet as of 12/31/26 because these errors basically self-corrected in the following period. So let's now go through over here and take a look at one of the harder ones, which is on January 2nd, 2025. Hudson sold for $1,800 a piece of equipment costing $3,900. At the date of sale, the equipment had accumulated depreciation of $2,400. The company recorded the cash received as miscellaneous income in 2025. So what I want to do here is let's move this down a bit. Okay. So what the company did was that they went through and they said, okay, well, we sold this equipment. We got cash of 1,800 and we had miscellaneous income of 1,800. Okay, obviously that was not correct. What should have happened is that when we're going through and recording equipment, right, basically what needs to happen is, well, we've got to take the equipment off of our books, right? When I take the equipment off of my books, I need to credit I need to credit equipment because equipment, remember, when we go through and we purchase equipment, right, I'm going to be basically putting the balance over here. So I have to credit equipment to get it off of my books. For the accumulated depreciation on the equipment, what I'm going to need to go through and do is, because that accumulated depreciation on the equipment, this is a contra asset account. So the accumulated depreciation on the equipment basically needs to be debited. To go through and to basically the rest part of my journal entry is I'm going to show the cash being received. And then also I'm going to be kind of going through over here and saying if I'm going to have a gain or a loss. Now, when it comes to this over here, the equipment basically had a balance of 3,900. And then over here, the accumulated depreciation on the equipment was 2,400. So had I gone through and done this journal entry correctly, what would have happened would have been is like, okay, I look at my total debits, I look at my total credits. To go through and to record this properly, I would have had a gain on sale of equipment of 300. Now, in this case right over here, I actually went through and recorded a miscellaneous income of basically of 1,800. So what I would need to go through and do in terms of my adjustment is I reported $1,500 in 2025 of too much income. So over here, what I'm going to need to do on the income statement is I'm going to reduce my 2025 number by 1,500. Okay, so again, this is what I did. This is what I should have done. I basically went through and recorded too much miscellaneous income. So effectively, I would need to basically debit miscellaneous income for the 1,500, and then that would actually get me to the correct gain on sale of equipment. Okay, now there's some other problems with this, right? Is that in addition, the company continued to record depreciation for this equipment in both 2025 and 2026 at a rate of 10% of cost. So this over here, recording depreciation, okay. So at 10% of cost, cost was 3,900. 10% of that amount is going to be 390. So I need to add back 390 for 2025 and 2026. Now, there's one other kind of an issue here as it relates to the equipment. On my books, right, I basically never went through and basically fixed the equipment coming off of my books. So in 2026, right, as I'm kind of going through over here as a debit and credit, I would remove this over here by 3,900. I would remove the accumulated depreciation on that equipment that was actually going through an existing of 2,400. At the same time, when I'm going through over here and when I was going through and recording the depreciation expense, basically when I record depreciation expense, the journal entry I'm going to use is depreciation expense. This is what I did over here for 390. I'm crediting accumulated depreciation on the equipment for 390. So if I'm going through and adding these back, right, which is what I just went through and did, I'm also going to have to basically put these amounts here as debits to go through and to reverse this out. So if we kind of go through over here and let's see how Bennett did, overcharge of depreciation, looks like I did this part of it correct. So that is my, basically that's my video for this. As I look at these parts over here to record depreciation expense or to record retained earnings, I mean, I'm not going to go through these journal entries. I'm not going to go through these journal entries for has not or has closed, rather that hopefully that this part of it over here makes a little more sense. And we'll just kind of, let's go through and add up our numbers. So we have over here 14,500, 22,030, and then 10,050. There we go. Okay. So I want to thank all of you for being with me here today for this question. And this is a shout out over here to Sticky Waffles Productions 4009. So thank you for liking and subscribing to the channel. And I look forward to seeing you on future videos. Again, if you have questions on how to do certain questions, and if it's in my test bank or if I have the ability to do so, I'm more than happy to do it. Have a great day and we'll talk soon.